This is yet another shallow dive. Today, we're going to be looking at a company that's been in the news a little bit. There's a huge story behind it. By the way, this video is brought to you by regret. It's that thing that you could have done but didn't. Okay. Intel Corporation, ticker symbol INTC. We're going to be looking at many metrics here, including a little bit of an overview real quick. That's the stock price out here, going out all the way to 1981. And after that, I'm going to rate it on an extremely scientific, proven measuring system. This is not going to be a DCF analysis, as you can tell. It's going to be a kitty analysis. We have 3 ratings here, and it's come to my attention. Somebody brought it to my attention, a comment that I can put more than 1 point in a specific category whenever I rate something, whether it be revenue trend, cash on hand, whatever it is. If I think it's worth more, if I want to emphasize it, I can put multiple points. So I'm going to do that today. I'm going to try it and see how it works and see what kind of conclusion we come to. So we're a little more flexible in our ratings. Now, back to the company, starting with the quick overview here in the bottom right. You'll notice the revenue and profits trends for the last, I don't know how many years, 7 years, but it's a little bit deceiving, and I'll show you why. All right. Before we get into it, this is the profile of the company. I think we're all familiar with it. They make chips and other products related to that. They're a tech company, one of the most old school ones in Silicon Valley and the Bay Area in Northern California. As I just pulled up the max chart in the very beginning of the video, and you can see that this company was about the same price in 1998. So if you held Intel for the last 25 years, you're at no gain. You may have collected a few dividends along the way, but you aren't even outpacing inflation. So just to start, this company does not have a record of beating the market, right? Even though it's a very techy company, it is not a good record. Now, they're trying to change that, but we'll talk about that when we get to the story portion of the video. First, as promised, we're going to go through the key ratings, revenue trend, going in deep into the financials. Now, if you look at this annually, everything looks hunky-dory. However, going into quarterly to view a little bit more definition, we see that the last 2 quarters have been suffering in revenue. Now, that's bad news. Of course, the rest of the economy and many other product manufacturers have suffered. However, it's not necessarily the case with all chip manufacturers. I know that, Taiwan is kind of a politically ambiguous territory at the moment. But if we just look at Taiwan, semiconductor manufacturing, pull out to quarterly and look at the revenue, you see that have extremely accelerating revenue. I even heard a rumor, I think it's a fact, that Warren Buffett's boys bought some Taiwan semiconductor manufacturing and folded into the Berkshire Hathaway. So I don't know the specifics, but I think that is the case. Now, as far as revenue trend goes, this is not good. I mean, it was climbing up until the latter part of 2021, and 2022 has been really bad. I mean, it's like 4 quarters of declining revenue, basically. Now, it's possible that their efforts been put somewhere else rather than, actually growing the top line, and is the case. However, you don't want to let that line go out of control, and I think that the fall has been pretty substantial. So I'm gonna have to give it just a 1 sourpuss here, the 1 sourpuss rating. Now, going into the next rating is the earnings trend. So we're gonna look at earnings. I'm gonna go down to net income, and we'll see that the net income is pretty bleak. If you look at the last 2 quarters, they're awful relative to the rest of their performance in the past. The first quarter of 2022, it looks like they got over 7.5 billion of income, which is a really big number. The last 2 quarters have been really bad. Now, I know that, they're spending a lot of money for some reasons, but of course that goes into the story portion. If we just look at the earnings trend itself, it is abysmal. And this is a huge drop. And in fact, I'm going to double the ratings here for the first time ever. I'm going to give it 2 sourpuss ratings, totaling a 3 right now, which is really, really not a good start. All right, next on the list, dividend and payout ratio. Now, just looking at these statistics by themselves, the dividend is really fat. It's 5.09%. Dividend growth is solid at 5%. Payout ratio is 44%. It's not horrible. It's a little on the high side in my opinion. But if you look at this ever-increasing trend of dividends, that should give you a pretty reassuring picture. However, just with, as is the case with any company, you need the underlying business to be able to support those dividends. Otherwise, you're just going in debt as a business trying to pay out these dividends without having that income coming in to back it up. So dividends by themselves cannot be looked at alone to determine whether or not something is a good investment. And that's the question that we're trying to find out today, is whether Intel is a good investment or not. So far, not too bad. So the earnings themselves, if we look at them in isolation, they get 1 point in approval cuts. They do. Just by themselves. They pay regular dividend. They have been paying it forever. And, going back to 2013, you can see a record of increasing dividends. So the chances are that if you buy the stock for the next 2, 3, 4 years, it's going to keep paying out those dividends without decreasing them. Once this payout ratio goes to 100% or more, then we're really in trouble. Next on the chopping block is share buybacks trend. All right, this is an interesting one here. So what is a share buyback? Well, the shares are basically part ownerships of the company, right? So a company has a choice to go into the open market and buy some of these ownership pieces away from investors for some price and retire those shares. The effect that has is that whoever is left owning the shares is a bigger part owner of that company. So your shares in essence are becoming a little more valuable if the all else is equal. Not always is all else equal, by the way. By retiring the shares, they're getting rid of cash, so you in effect own a larger part of a lesser company. So it's kind of a non-event, but it's a good window to figure out what management is actually trying to do with the money on hand. Are they trying to return capital to shareholders? Are they trying to tap in the shareholders for more money in order to grow the company? So that's why we're looking at it next. Shares outstanding. You can see this is the yearly trend here, but let's go to quarterly and see a little bit in higher definition what's going on. So they've been buying back shares since 2013 all the way into 2020, after which they've started issuing a tiny bit. So the company proportion that you own with one share has not changed much since 2012. It's kind of a boring story here. I guess they're either investing here or I don't think they're in trouble, or maybe they issued some shares in order to pay the dividends. Either way, this is a very slight change. This is a solid 1 board kitty rating here. Next is cash on hand. How much cash does the company have? Well, we can figure out by looking at the balance sheet, but we can also look at the statistics and notice the relationship between the enterprise value and the market capitalization of the company. That difference should tell you how much cash they have. If you subtract the two numbers, you get, like 15 or something, negative 18 billion, not thousand, I wish. And it looks like negative 16 billion, 16.96, so $17 billion in debt, net cash over here under the balance sheet. I also am interested if that debt has been growing as of recent or has been decreasing. In order to find that out, we go into the balance sheet here. We go under total debt, and you'll see that debt's been increasing as the years are going on, even though they've been paying dividends. So as I suspected, they have been issuing debt to pay those dividends, basically. They're using the creditworthiness as a tech giant in order to pay those dividends. Well, now then, cash on hand is not good. 17 billion in debt. It's not a large portion of the company, and if they're using it productively, it's actually not too bad. Um, I'm not a favor of companies running huge debts, but in this case, I see what they're trying to do. It's kind of not really a fault or a plus at this point. I'm just gonna give it a board key rating of 1 point. Price to earnings. Let's get in some valuation. We'll go in the statistics. The PE should be somewhere around here. PE is 8.67. For a company like this that hasn't been growing forever, it's actually pretty fair. It's considering the last couple quarters they were completely non-profitable. Their PE is like infinite, right? But just the fact that those strong quarters bring the PE down is kind of positive. That means they at least have the potential to make some money. I don't know if that's an approval cat's PE. How about we do this? For first time ever, we'll put 1 in board kitty and 1 in approval cats. It's half and half. Enterprise value over earnings. Just 1 line down, 1 box down. EV over earnings is 10.04. I'd say the same thing here. 1 board kitty and 1 approval cats for the valuation. Enterprise value over free cash flow. Okay, this is an interesting one. It tells you a lot about the business. EV over FCF is NA. They haven't had very positive cash flow because they're expanding and investing in big projects. So I don't know. That's kind of negative, but also a little bit positive as well. I know it's kind of contradictory, but it's a risk, so I have to split my decision. So see, this is what happens when I don't have to pick just one. I end up splitting. Okay, profit margin. All right, let's see. I heard him talk about the margins taking a hit. So let's take a look here. We'll go under financials and profit margin. Oh, this is yearly. Let's go to quarterly. Profit margin quarterly. Huge drop in the last 2 quarters. They had an over 40% profit margin first quarter 2021. Wow. Their profit margin is usually over 20% or at least around the 20% mark. And they've completely plummeted in the last 2 quarters. I guess they picked a bad time to invest. They should have been investing last year. All right. But I guess sometimes you don't make changes unless things start going wrong, right? So it makes sense, I guess. Either way, profit margins are in a dumpster. I would say it's a sourpuss. Profit margin trend also bad, so we're gonna put 1 sourpuss again here, 6. And then the story, which is the biggest part of this entire ordeal. The story of this company is very important. So they used to be the leading chip manufacturers. They couldn't make their stock go up for so many years, being the lead chip manufacturer. Now that they're no longer in the spotlight, they're trying to fight tooth and nail to reclaim that title. People, companies like Apple, have decided to make their own chips. The chips are better. There's Taiwan Semiconductor is probably making better chips too. So there's a lot of competition out there for Intel when it comes to that market. Their CEO and their entire company, under his direction, is hell-bent on making that comeback. However, that doesn't come easy. First, you need huge amounts of investment, and second, you need the talent. I know that they're putting in the investment. I don't know what they're gonna do about the talent. I know that they are building a facility in Ohio, which is one of the first manufacturers that I know that are trying to bring people in on the high-tech side rather than outsource in other countries and pick the brains of countries other outside of the US for regulatory reasons and also for cost benefits. Now it looks like that's backfiring to an extent because the relationship between China and the U.S. is worsening, and other countries in the world in U.S. is worsening. It's not as easy to move talent around the world. It's not as easy to operate in other countries without considerable political risk. And so Intel kind of saw the writing on the wall, and decided to build in the U.S. in the safest jurisdictions out there, especially for a U.S. company. So it makes a certain amount of sense. I don't know how much it's going to cost them. It seems like they're paying an arm and a leg for the move so far. I don't know how far into the move they've gone. I think it's a fairly recent announcement. However, I don't know how long they've been doing it already before they announced that. So it's a very interesting move. I think it's a move out of desperation, right? If they don't make a move, the company's going to die, like literally. So I see it a little bit like, when I used to play tennis, right? Still play for fun. There is this theory, or this axiom, I don't know what you call it, where sometimes more risk is less risk than the safest thing, right? So basically, if you're pushed in the corner and you're about to lose the point, if you just do a safe shot back and you just continue doing what you're doing, so you have to go for something riskier to put your opponent in a disposition. And so you go for kind of a Hail Mary, right? It's the same concept. You go for a Hail Mary, you try to do a very difficult but a shot that you think could put you ahead in the point, and suffer the consequences if it doesn't work out. So you go from having maybe a 1% chance of winning if you just float the ball back, to maybe a 5% chance of winning if you go for a risky shot. So from some perspective, with this next move that you're doing as a company, or your next tennis shot in the analogy, you've just quintupled your chance of winning, right? You went from 1% likelihood to 5% likelihood. However, it's still 5% likelihood. You see what I'm saying? You still got 95% chance to lose. So that's what I'm seeing unfolding here with Intel. Like, they're on the losing end of the points. They've been pushing the ball for a while, and now their opponent is in a really good position to put the ball away. And they're scrambling to try to do something else. On one side, I see that they're in trouble and they're struggling, and if this thing doesn't work out, they're toast. Especially burning through cash so fast. But if it does work out, it could put them ahead of the game, and talent will once again flock to Intel, and they'll get to rewrite history once again. Now, is that going to happen? I don't know. Is it more than 50% chance? I'd say no. It's not more than 50% chance. So in order for this investment to be good, in my opinion, you would have to have a substantial discount to account for the fact that this company might be going under in the next few years if their plans don't work out. Because if this Hail Mary doesn't land in the right hands, it's not going to be a touchdown. That's for sure. Alright, hopefully you enjoyed this. Let me know what you want to hear about next. I'm up to review any company that you want. Hopefully not an ADR though. Not something foreign. I want to be able to look at it in stockanalysis.com. So I can do a little shallow dive that way. Alright, that's it for now. Peace out.